Hey everybody, and welcome to the second and final video from Chapter 5. Today we're going to be talking about the term structure of interest rates, and specifically what that means, and then we're going to talk about a specific theory called the expectations theory of the term structure. So, we define the term structure of interest rates as the relationship among the interest rates on bonds that are otherwise similar but that have different maturities. So, we're talking about like the differences between a 10-year Apple bond and a 20-year Apple bond, where the only difference is the maturity date. And the most commonly referred to example of this analysis on the term structure is the Treasury yield curve. And I'm going to get to that why it's so important in a second. But in figure 5.4, you can see three different examples of this term structure, and we call it the Treasury yield curve. So the three examples are taken from right before the Great Recession in 2007, right in the middle of COVID in 2020, and then in 2019 when something specific happened. And I'm going to explain what is going on here right now. So generally speaking, the yield curve is always going to be upward sloping. And the reason for that is just because the probability of default always increases with time. So, for example, with Apple, on are they going to default on a 1-year bond? Probably not. Are they going to default on a 20-year bond? Possibly. We don't know what's going to happen for Apple in 20 years from now. So, as we increase time, the default risk increases just because there's more uncertainty associated with the investment. However, in rare cases, we can see a downward sloping yield curve, or what we call the inverted yield curve. And this happens really specifically with U.S. Treasuries. And this is when some of the maturities start dropping in yield over time. And this isn't a function of any economic outcome. Rather, it is a function purely of investor sentiment. And so, how that works is if an investor thinks that short-term yields are going to rise in the future, then they will start shifting to long-term bonds and away from short-term notes. And it's a signal of possible recessions. And what do I mean by that? Well, let's just say an investor thinks that in the future, in the next year, there's going to be a recession. Well, in the very short term, before stimulus activities happen, the yield on short-term notes should rise because during recessions, there's always going to be an increased risk of default. And so, if an investor thinks that's going to happen, they're not going to waste their money tying it up in a short-term yield now. They're instead going to invest in a long-term yield, and then when those short-term yields increase, they shift their income or money into short-term yields. And so, really, the reason why we care so much specifically about the yield curve is because when it inverts, that is generally an indicator that investors think the economy is overheating. And if you look at figure 5.5, there's actually a pretty strong correlation to suggest this is a good indicator. So every single pink area is a US recession. And if you look at every single one, there is a closing of the yield curve or an inversion of the yield curve for every single one. So that is saying that before every single recession, investors agreed that the economy is starting to overheat. Now, we can get into correlation versus causation, and a lot of investors still argue this about whether or not it's causal or just, a chance correlation. However, what is undeniable is that there is strong evidence to suggest, even down to COVID, that this yield curve is a decent indicator of possible future recessions. And that is why when it inverted in the summer of 2019, so many investors got extremely leery and started freaking out a bit. Now we're going to finally talk about the expectations theory of the term structure. And this is a bit of a mouthful, so we're going to walk through it step by step. What this says is that the interest rate on a long-term bond is the average of the interest rates investors expect on short-term bonds over the lifetime of the long-term bond. And there's two considerations that go into this. First, that investors all have the same investment objective, which is to make money. We can talk about risk preferences and wealth, but at the end of the day, regardless of all of that, everybody just wants to make money. Additionally, we need to stylize that investors view bonds with different maturities as perfect substitutes. So, what do I mean by that? An investor should be agnostic on whether they want to choose or want to hold a 5-year bond for up until maturity and then buy another 5-year bond up until maturity versus a 10-year bond and holding it to maturity. They should not have a preference between either one of those investments, except for the return that they may provide. And so let's really dig into that last statement specifically. So we're going to compare two strategies. First, the buy and hold strategy, which says that we're going to buy a 2-year bond and hold it to maturity. So we're going to assume that we're going to invest $1,000 into a zero coupon bond with a 2-year maturity. This means that it should grow to a future value of $1,000 times 1 plus the interest rate squared. And our total profit is the future value minus the present value. And our ROI specifically is going to be 1 plus I squared. So keep that in the back of your mind. Now let's look at the rollover strategy. The rollover strategy says that we're going to buy a 1-year bond and we're going to hold it to maturity. And then we're going to buy another 1-year bond and hold that until maturity. So we're going to invest $1,000 into a zero coupon bond with a 1-year maturity date so that the future value is equal to $1,000 times 1 plus the interest rate for the first year. And our profit is just that future value after the first year minus the present value. But then we're going to take all of this future value and we're going to invest it into a zero coupon bond with, again, a 1-year maturity. And so our future value after 2 years is equal to the future value of the first year times 1 plus the second year's interest rate. And this defines our profit. So let's look at the two ROIs. Well, the ROI from the first option is equal to 1 plus I squared, whereas the ROI from the second investment is equal to 1 plus I1 times 1 plus I2. So which do you prefer? Well, if you think that strategy 2 is going to give you a net higher interest rate, then you should go with that. However, if you think that strategy 1 is going to give you a higher ROI, you should go with that. And the assumption is that under perfect information in the market, investors all know this. And remember, we assumed that investors are also agnostic onto which strategy they prefer. They only care about what the ROI is. This means that if too many investors think that strategy 1 gives us a higher ROI, then it's going to start to deflate that interest rate and it's going to increase the value of the second one. And then we're going to have the market go back and forth until we get the two ROIs equal to each other. And so this uses some basic economic mechanisms along with these two assumptions to get the idea that this ROI has to equal that ROI. And so by extension, the interest rate on the 2-year bond is just going to be equal to the average opinions of these sub-segmented ROIs on the interest rates. But this isn't a perfect theory. It does a poor job with interest rates on long-term bonds being so much higher than short-term bonds. And one of the key determinants of that is risk aversion. And what risk aversion is just saying is that investors don't perfectly believe in this substitution effect that we're just looking at interest rates. They don't know what is going to be happening, in the future. And so there's going to be more aversion and there's going to be some sort of added premium on these longer bonds because, with our previous example, it gives our investor the ability to evaluate the situation after 1 year. It also just broadly overlooks basic behavior that is observed in the perceived risk structures in the market. And so that just means that these investments don't move in this way. In fact, it actually does a pretty poor job of encompassing what we actually see in modern investment behavior. And the big question that you guys would get a job anywhere in the US at any big bank that you want, if you can figure out, is what? What is this background mechanism that is causing this poor relationship between the expectations theory of term structure and what we're actually seeing in the markets? But we're going to close on that. You now have everything that you need to complete the Chapter 5 quiz, and then you can start moving on through the Chapter 6.